Hi everyone, this is Demo Gonzalez of Heartwood Financial Services. Welcome to our latest market update and outlook video. So the title is the Fed cuts versus the government shutdown. So this is what's been on the news. And so what I want to talk about is who's going to win. What's the stronger force here? Is it going to be what the Fed is doing or what's going on with the government shutdowns, which can be very disruptive? And of course, I'm going to talk about that. I'm going to talk about what's going on with the economy and what we're doing here at Heartwood Financial Services with the portfolios to work around some of these current trends. So I hope you enjoy it. Let's get right into it. All right, let's get started with the asset class returns for the month of September. If you watched my video last month, you've heard how September can oftentimes be a pretty lousy month. Well, look at this. We have a pretty good month for the month of September. You can see the green bars are all positive. I guess I just had to speak it into the universe, right? But as you can see, it was led by large cap stocks and international stocks, but pretty much everything. Fixed income was up, commodities were up, real estate was up. And so what we're seeing here is the Fed has been starting to cut rates. We're going to talk more about that here in the update and why. But that's been kind of lifting all boats, as you can see. But the other part that you don't see here as well, because I didn't put together a quarterly number, is that there's been breadth as well. You're starting to see small caps, real estate, some of the other areas of the stock market do pretty well and start to catch up. Although we didn't see that quite as much in the month of September. But that is a very good sign because there's been so much in the gains in the large cap stocks. It is nice to see some of the other parts of the stock market participate. I'll also highlight emerging market stocks here. They've done very, very well, especially lately. And that's a lot to do with the dollar. The dollar has been coming down. It's stabilized here right around the Dixie is what they call it, right around 97, 98. It's been there for about 3 or 4 months, and emerging market stocks like it when the dollar's kind of low and kind of weak. And so we've seen some of that. That will probably continue. We'll talk more about that in the outlook. All right? So stay tuned. Let's get going. All right, quick update on how the economy is doing. Label this the Big Three report. I have 3 different economic indicators that we look at: the manufacturing, services, and the employment numbers. So we have the ISM manufacturing numbers that came out, and you can see the trend is actually moving up, which is nice to see. It's still below 50, which is in a contracting stage, but since manufacturing is a smaller part of our economy, it's not necessarily a bad sign that it's just below 50. In fact, it is trending up, which is actually a pretty good thing. So we see that as actually a pretty positive sign overall for the economy. But the other 2 are a little bit more concerning. The ISM services just came out this morning. I'm recording this on Friday, and it came out at 50. I'm not really happy about that number. The 50 is just barely growing. That means it's not contracting, but it is trending down because last month we were at a 52. Okay, so services is the bigger part of the economy. That's 70+% of our economy, and it's kind of flattening out. So that's not very encouraging to see. And then the last piece is the employment report. And you can see it's called the BLS employment report. BLS is a government agency that is not open right now. We're going to talk more about the shutdown. But without those numbers, we really don't know what the unemployment number is and what the rate is. But I can share with you the ADP report that came out a couple days ago, which is the private payrolls number. It was down 32,000. So this is not a good sign. Not to 32,000 plus, negative 32,000. So the expectations is for the BLS to be around 50,000. We'll have to see. But this is definitely not a good sign. So this is trending down. So the labor market is weakening. And now with all the adjustments that they've done to prior numbers, we see that the labor market really has been kind of weakening here for a while. So that is not a great sign for, people going out and spending money if they're not, if there's more and more people that are unemployed. So that is definitely something to watch out for. I'm not ringing the bell on recession or anything like that because the other numbers are still holding up pretty well, but it's definitely a cautionary sign that we're going to be keeping a close eye on. All right, and so inflation has been a big part of the news cycle here for the last few years. And so here's a quick update on what's going on with inflation. You can see that over the last year, it's basically gone nowhere. The blue is the core inflation, which excludes food and energy. The orange one is what they call the headline number. It includes everything. And we're pretty flat for the year. It's actually up slightly for the year, but not by much. On the month-over-month numbers, we had a positive 0.3 and a positive 0.2. So it's a little bit hot. If you annualize those numbers, that's 2.4, 3.6. Not great. The goal for the Fed is to be right around 2. But when we're starting to see the labor market get a little weaker and inflation not really inflating too badly, you can see why the Fed is starting to kind of change their tune a little bit. This is not freaking them out too much. Now, we have seen some inflation coming through from the tariffs, and it's mostly been on the good side of the ledger, so to speak. But again, the goods is only a small part of our GDP, so it's not having this really big impact. At least not yet. We might see more of that to come, but I'm sure that's conversations we'll have more here in the future. All right, and probably the biggest news that broke in September is the Fed had their meeting, and it was the first time they've cut rates in about a year and a half now. So they officially cut the Fed funds rate by 0.25%. So now we're at 4 to 4.25 range. That's going to affect money market rates, CD rates, checking, savings, all that stuff. You're going to see the rates come down a little bit. And that's actually been a very uplifting sign for the stock market. You saw how September did with the asset class returns. It helped buoy the stock market, even though we're seeing some concerns with the labor market. And we're still, there's still some trade tensions out there and some confusion. So even with all that, the market's still up. The AI enthusiasm's still up. But the big factor, I would say, is also because of the Fed. And we're going to talk about more about what's coming with that here in the outlook. All right, in the title, I'm talking about the battle between the Fed cuts and the government shutdown. Who's going to win? Well, here's a little clue. As you can see here by the chart, that despite all the headlines, past government shutdowns haven't had huge negative market declines. And so an interesting pattern that I observed when I was looking at this chart is that the government shutdowns were shorter back in the 70s when this was first introduced as a ploy or a strategy by the party that's in the minority. And it did have a little bit more of a negative effect back in the 70s. But as more trends are maybe there's more experience with these types of tactics have come out over the years in the 90s and in the 2000s, we can see that not only are the shutdowns lasting longer, unfortunately, but they haven't had as much of a negative impact to the stock market. And in fact, the last time we had a shutdown, it was a pretty long one. It was for over a month, but the market actually was up 10% during that time. It was actually one of the best performances that we've seen in a month, ironically. And the average for the stock market, again, that's the S&P 500, and you can see the notes down here. It was up 3.68% on average. And so that's actually a pretty good return, especially considering that some of the time frames here are pretty short. All right, the other part of the battle is you got the Fed. The Fed's been cutting rates. Okay, so the question I've been asking myself a lot is how is it that the stock market has been holding up so well? We've had shutdowns, we've had a little bit of a hot inflation, and as you saw, we're starting to see the labor market soften. And I think it's because of the rates. Not only did we get a rate cut, but we also have the anticipation of more Fed rate cuts to come. So there's a 99% probability that we're going to get a rate cut in October, and a 91% probability that we'll get 2 rate cuts before the end of the month. This is a pretty powerful tool that the Fed has to lower interest rates that will lower borrowing costs, especially on the short end, and help banks and help short-term borrowers and things like that. And so it's, I think, as you can see, it's winning so far. So round 1 goes to the Fed. Could there be some hiccups? Yes, of course. If this shutdown lasts more than the 34 days, it could start getting a little ugly and a little scary. At the end of the day, the party that's usually creates the shutdown usually doesn't get what they want. Unfortunately, it can cause a lot of disruption, so we'll see what happens. Hopefully, they'll end it quickly. But if it's something that lasts for just a couple weeks, which is the consensus, for the most part, the Fed is going to be a much more powerful force for the market to continue to move in a positive direction and hopefully help alleviate some of those labor market concerns that they're starting to see. All right, so what are the implications to all this? We can see that my thesis is the Fed will ultimately win this battle here with the shutdown, but there's probably going to be other battles that are going to be coming here, but the Fed is going to be a pretty powerful force overall. And so for right now, we're still playing it pretty neutral. We don't see the stock or the economy completely breaking down. We're seeing some softness. And that's actually could help the inflation come down, ironically, which would allow the Fed to cut rates a little bit more. When we got Fed funds rates at 4 and 4.25, there's a lot of room for them to cut to alleviate any stresses in the stock market. So with that amount of firepower, I'm still staying pretty constructive overall for the stock market, but with a little bit of caution being that, things could slip a little out of control if we don't get the labor market situation fixed. So what we're doing right now is I'm starting to trim a little bit of the small cap stocks. They've actually been doing pretty good, and so I'm going to be kind of selling them a little bit into strength because when the rates come down, those small cap stocks do a little better. All right, but if we're slowing down and if we slow down a little too much, I really don't want to have a big exposure to smaller companies that tend to be more sensitive to the economy. And then I'm going to be adding that to emerging markets. Emerging markets, as you saw in the update, the emerging market stocks have been doing very well. The dollar has been kind of weak. If the Fed is cutting rates, it's going to keep the dollar from strengthening too much. So emerging markets and international overall will probably do okay in that scenario. So I think I'd rather play a little safer and go with something that has a little bit of that upside with the trend we're seeing with the Fed. Everything else, we're kind of staying as is. We've already reduced some of our longer duration bonds. We're staying with gold and some of these areas on the other categories. Everything is kind of the same there. But that's pretty much it. I hope you guys found this helpful. Please feel free to share the video. Comment below if I got something wrong or if there's something that you think I should be aware of or looking into. Or, of course, you can always reach out to me and give me a call. I'd love to hear from you. But thanks again, and God bless. Bye-bye. Off my head. He's like, I got a drink? Is there a drink there? Bye!